Good morning, everyone. A start of another wild week in Wayne's World. Welcome. For the next hour, I'm Wayne, and you're in my world. We have one of the busiest, wildest weeks we have seen in a long time in the economy. And because of a lot of speculation of some rather aggressive moves by the Fed, I thought I'd come back and look at winflation again, because this is a time when you, as a real estate professional, could be winning in inflation, getting ready for a recession. And I was just looking at my phone, and some of the different places I follow led me to believe what's going to happen. Here we are today honoring Queen Elizabeth's funeral, so pretty much a lot of activity is limited, so to speak. But tomorrow, U.S. housing starts are identified, building permits and earnings. I like to watch Stitch Fix to see some information, but you probably have some other sources. But realize tomorrow we're going to find out a lot about U.S. housing starts. And then Wednesday could be a wild Wednesday. The Fed is ready for its next meeting. And by this next meeting, you may have heard, or if you haven't heard, you should realize there's a lot of speculation that a minimum of a 0.75 basis points raise, which will be 3 consecutive Fed meetings of 0.75, 0.75%. Some people actually believe we could see a 1% increase by the Fed, which means since March, we had 0.25, then we had 0.5, then we had 2 consecutive 0.75s. So we already are up 2.25%. If some of the economists feel we'll see the 1% increase, we'll be up to 3.25, which means with 2 more meetings of the Fed, we could be at 4.25 or close to it. The Fed is basically very much concerned and has never in my history been as aggressive in raising rates. In fact, if indeed we get to close to 4.25 by the end of the year, that would mean in less than 6 Fed meetings since March, 3/4 of a year, we've increased the rate by the same percent we did over 17 meetings of the Fed back in the 2004, 5, 6, 7, 8 range when they started raising rates. It's been a long time ago, but this has to be something you'll be aware of. We could be seeing in 9 months, in about 6 or 7 meetings, what it took the Fed to do in 17 meetings. This is by far the most aggressive. And the fear of too much aggressiveness will mean we're going to get into a recession. You can't blow up the balloon real fast. It'll break. You got to blow it up slowly. But we are in such a dire straits based on the numbers we are seeing. Stock market going down by 1,200 points the same day the president's announcing the Inflation Reduction Act and talking about his successes. A lot of confusion in the marketplace. And with that said, I think there's a very important concept to think about as we begin our day today in Wayne's World. First of all, money talks and wealth whispers. This is the time to build wealth by buying assets that make more money. We will talk about 5. They're the 5 I talk about all the time. I've talked about them in the 80s. I'm still talking about them in 2022. Anytime we have an inflationary market, there are some better ways to protect yourself and not worry about inflation, but realize it's winflation. I would like to buy assets that make more money. I obviously am very biased towards our profession and buying investment real estate. Whether you flip or whether you hold or whether you do both, there should be a portfolio that continues to grow for you. At least 2 income properties per year until you are no longer a realtor. If you want to do some flipping, those are extra. You could buy 1 or 2 flips, get rid of those, take care of the short-term profits and enjoy that money, but also don't forget to work for the long term. Real estate wealth building continually builds more passive income than real income. A short-term flip gives you some real income real fast. Long-term appreciation, buying and holding real estate, gives you the passive income, which we will talk about, and why I say real estate is not the best investment, it's the ideal investment in Wayne's world. Looking at that, the key focus to realize is something that was said years ago. It's been paraphrased in many ways, and it was something that was set up by Mark Twain, but the bottom line is past performance is not an indicator of future results. The point, though, is over the long term, real estate always looks at a growth that's consistently better than any other type of investment. Plus, one of the few, if not the only investment that gives you so much more than just income or profit. And that's why it is the ideal investment. But it also is based on risk equals reward. Not everybody is willing to take as much risk. Yes, I can see some money market funds at 2.1%. That's very safe. It's a money market fund. I see some CDs that are very safe. I see many other investments that at 1-2% are safe. But gosh, what about the power of real estate as an investment? Plus 4 other ones I want to share in a few moments. Mark Twain, as I said, created kind of a phrase that we still see and use in the marketplace. Those who don't understand history are bound to repeat it. The more you know about the past, the better you're prepared for the future. And that's Theodore Roosevelt's quote. But again, because I'm looking at what could be in less than 9 months, the same growth in interest rates over 4.25%. Let's put that in perspective. If by chance by December the Fed follows through with its anticipated plan to get us to 4% or more, depending on what they'll do Wednesday, but again, the majority of people out there right now, unless something changes between now and Wednesday, could see the 1% rate hike that follows 2.75 basis points. See, in the past, it was 0.25, 0.25, 0.25, 0.25, 0.25, 0.25. It wasn't 0.25, 0.5, 0.75, 0.75, and now maybe 1, with 2 more rate hikes left. That means on a $100,000 loan, 4.5% increase is $4,500. That's roughly close to $400 a month more after taxes to buy the same thing you could have bought at a lower interest rate back in January. So put that in perspective. $300,000 loan, we're talking a $1,200 extra income per month to support that. Or if you have an adjustable loan or your credit card interests are up, this is scary. The numbers are staggering. I just got a credit card statement. My credit card statement was for about $12,200. I can pay it in full and pay no interest. If I just want to pay them the minimum payment because I'm shortchanged, lost my job, didn't get enough overtime, whatever, I can't pay the bill in full. I can give them $129 a month, and they're happy. My credit looks good. Everybody's happy, except for one small factor. The Federal Trade Commission said now credit card statements have to show by making the minimum payment how long it will take you to bring that balance down to zero. People, this is staggering. My credit card statement said if I charge no more on that card, stop charging on that card, and continually pay $129 a month, it will take me 60 years to pay that off. Can you see the problem we are having when people can't delay instant gratification and buy the new this and the new that, replace this or go get that? Credit is a power tool in a consumer workshop. Like any power tool, if you use it right, it makes life so much easier, whether it's a kitchen appliance or a tool at your workbench. But if it's used the wrong way, it is deadly. It can injure an arm. It can cause a finger to be lost. It can cause bankruptcy. It can cause credit repair. It can cause debt consolidation. It can cause credit cards being dropped. Those who don't understand history are bound to repeat it. Just a powerful concept to keep in the back of your mind as we move forward. So it wasn't that long ago, we were at 3.15%. Obviously, back in January, February. Then the Fed kicks in, and now we're above 5.29 in many markets. Or if you're lucky and pay points, it might be less. But the bottom line, those are huge increases, and we are back to the 1980s, which is a whole generation many people on this broadcast have not seen or heard of. But if you understand that history, you won't repeat it. That's what I'd like to share. Look at those 4.125% increases over a long period of time versus that same amount in a short period of time. The balloon is blowing up too fast with inflation, and we can't let the air out too quick or we don't know where we're going. So the Fed has a tough problem. We'll hear more about it on Wednesday and Thursday as we hear what they finally do. I'd love to say 0.75, but I got to tell you, if it's 0.75 or 0.1, it's still one of the most aggressive times in my lifetime where the Fed has never, and I know, raised rates 0.75 of a point at least 3 times in a row after a 0.5 increase. That was even not that common in past years. So we got a lot of changes, challenges, and choices as realtors in this business. So I thought we'd go back because inflation is not coming down. It's down a trickle. We're fortunate to see some low unemployment, but it seems like there's always people looking for workers. Everybody tells me there's a labor shortage here. I can't get workers for that. I got to close down for this. My hours change. So I don't know where they're all working, but they still don't seem to be solving the problem of a shortage of workers in the labor force, at least where I shop, eat, and do other things in my life. But we have headline inflation. That's the one that you see. That's the one you hear about. That's the one that pops up and includes major items. Now, we have seen for the first time automotive gasoline go down. We have not seen natural gas or propane go down. So we do have a break at the pump. There's no doubt about that. But that's a minor dollar amount. Unless you drive a lot of miles, 30 cents a gallon, 20 cents, 40 cents a gallon, that's $8 a fill up tops. How often do you fill up? Versus buying fruit, vegetables, meat, eggs, and other factors in the process. And so you got to be aware of the fact that you can make any numbers work. I have a crazy phrase about statistics, and it's just my personal feeling that it's easy to do. Anything can look any way you want it to. For example, in our housing market, some people quote the median price of houses in a marketplace to clients. Some quote the mean price of houses in a marketplace. They're two different numbers. The mean is not the median. And in some condo buildings or similar type housings, they call it the mode. Those are 3 different numbers. They're all accurate. But unless you know which one they're talking about, you could be misled. The average price of a home is based on the highest and the lowest times the number of homes. The median is how many above and how many below. Big difference in numbers. Do your own calculation in your board figures and see how median differs from mode. Mean, median, mode. 3 numbers to look at just to get comfortable with the process. But headline inflation is something you hear a lot about. It may not be you. That's the key. It may not be you. Core inflation doesn't get as much attention. But Case-Shiller and some other indexes show core inflation a lot. Much more valuable metric to watch because it removes the components that exhibit large amounts of volatility month to month. So it excludes energy and food products. Now, once again, every person has their own personal inflation rate, and that's probably the most important. In Wayne's world, I'm concerned about Wayne's inflation rate. What does Wayne buy that's impacted by prices? For example, I am a Jelly Belly fan. I usually buy my Jelly Bellies at Costco, 4-pound container, went from $21 to $36. Did a little shopping, happened to find Jelly Belly, the manufacturer, had a sale online. So instead of paying $36 at Costco for 4 pounds, I was able to get 4 pounds for $21. Now, one of the components of a solid inflationary plan, if you can do it, is food storage. So I now have 12 pounds of Jelly Bellies will be arriving at my house for me and my friends to enjoy. It's like I got over 1 can free by buying that way, because Jelly Bellies are part of my life. Restaurants are part of my life. Clothing, part of my life. Shoes, part of my life. I'm not worried about gasoline. I don't drive that much. Airline tickets, very much concerned about. So your personal inflation, which we'll talk about, is something you need to be aware of, because you may be worse off than the economy that you read about, or you may be better off, depending on your lifestyle, your way of living, and how you spend your money. But core inflation, if you're looking at anything, try to find core inflation and follow that and avoid the headline inflation. Headlines, as we know, tend to sell the blood and the gore. That kind of stuff sells because it looks worse than it is to most people, and it probably is. Now, the 8 major groups in the CPI, they're all there. Take a look at there and see. As I said, I'm apparel, I'm transportation, but not car transportation. I'm airfare transportation. I don't spend a lot of money on education. Recreation pops up. Medical care, I've got my insurance. Those of you that are independent contractors have your own insurance policy, may have taken a high deductible. Those things could impact you. How you get your medications. Many of my friends are buying the same brand of medication. I'm not saying I endorse this. I'm not saying it's right. I've never done it. But they told me for some of the more expensive medications, they're ordering from Canadian pharmacies, getting the exact same brand name. I have to assume it's the same. I don't know, but I would check it out. But the numbers were staggering when I heard what they paid by having it shipped from a Canadian pharmacy than for the exact same brand name, not a generic brand name. Food and beverage, that's an important part for me. So every one of us takes those 8 major groups and makes us their personal inflation rate. And you can get a feel for what's important. Hey, if you're fortunate to have your home paid off and have no mortgage payment, if you're fortunate to have a fixed rate loan, not worried about these increases, or if you got no major credit card debt. In fact, one of the best strategies right now is to pay your debt down as fast as you can on your credit cards. In fact, that's a strategy in Wayne's world. Borrow as much as you can, pay it off as fast as you can. That's how I love real estate investing. I like my money to keep working for me so I can buy more property. I can use the concept of leverage in real estate. And hopefully you will be doing that too as you buy your 2 properties a year. Please don't lose that thought. Best credit cards for balance transfers. Up to 21 months at 0% APR. It's nice to be able to have money so you can make decisions. Some people say cash is king, cash is queen, cash is pretty powerful, whatever. 21 months. We have a bank in Illinois called Byline Bank. I have no idea if they're nationwide or not. They have a 2.2% money market fund. I just took the credit card I just received for a 2% balance transfer fee, borrowed to the limit, 0% interest for 21 months. Every $10,000 I buy costs me 47 cents a day. but I'm earning a tad over 47 cents a day when I put that money in Byline Bank till I decide what real estate I want to buy. It's like a no-brainer. I'm actually making a tad, but definitely breaking even. I'm not losing money by buying money and by making my minimum payment every month at 0%. I'm building my credit rating up. So my credit score goes up. I've got cash flow in case I need it. If I don't need it, in 20 months, I just pay it off. If I bought something with it, I had 21 months for that investment to not cost me a penny. People, wealth building the Wayne way has got a lot of success. And there's other people like me, but they follow a different path or a different way of investing in real estate. The key is whether you buy 1 unit, 2 units, or get into a syndicate and buy 32 units. It doesn't make a difference. Real estate investments are one of the key components to blasting past inflation and calling it winflation. So, how does inflation work? Well, we just saw that we averted a railroad strike. Government stepped in and negotiated a deal. Have you read the results? They just were receiving a 14% increase immediately. 14% increase immediately. And I think their contract in 3 years goes to over a 24% increase. Now, what's going to happen? The railroads have 2 ways of handling that, really. Well, 3 ways, but 2 ways that make sense. Either they eat that entire raise and make less money, or they pass it along to us partially, or pass it along totally. Either way, we now have created what's called wage push inflation, because now it's going to cost more to ship things, because in most cases, companies do not eat increases. They pass them on to consumers. It's just kind of a secret way to pass it on, just like we have shrinkage at the grocery store. The cereal is less. The ice cream is less. We've talked about this. So wage push is going to cause somebody else to say, wait a minute, I got to pay more for this. I need a pay raise. And then somebody gets a pay raise, and then somebody else says, I need a pay raise. And wages go up. I have no problem if you work harder and are more productive to get paid more. I would offer anybody on this Facebook Live this morning whatever hourly wage you want to help me in my real estate business. Just give me a number. $60, $50, $80, $100 an hour. I don't really care. Just prove to me by the end of a pay period you've earned more than the 50, 70, or 80 an hour I'm paying you. I'd be foolish not to. If I could find 10 people who I pay $50 an hour to who bring me $60 an hour, I just made $50 an hour. Everybody made $50 an hour. They all got paid $50 and they're happy, and I got $50 of passive income. I didn't have to work for that money. 5 people worked for it and brought me $60 in an hour, and I paid them $50 of it. This is a no-brainer. In addition to the demand pull and cost push and other built-in inflation, this wage push inflation is scary. It's easy to settle in negotiating a wage dispute when you're offered 14% immediately. So you decide how you feel that should have been handled, but it's been handled. Now we have other issues popping up in wages. So then we have demand pull. Where we at in housing? People want to buy them. We got more people that want it than there's houses. What do we have? We have demand pull inflation. In the Chicagoland market, we have rent inflation. People are doing multiple offers on rents. You might offer your house for $2,000 a month or your property. They're bidding it up to $2,100, $2,200, $2,300, whatever. We have a shortage. Shortages create demand pull inflation. And then we have cost push inflation. Wage push inflation will almost always lead to cost push inflation. Almost always. Because things cost more and we're passing them on to you. Some companies actually will show you what the increase was that they had to add because of. Restaurants are amazingly subjective to the high prices of vegetables and items they need because of the cost of shipping them and the cost of growing them and shortages because of various catastrophes, flooding and winds, etc. A lot of damage to crops. So we have a lot of cost push inflation, plus the built-in inflation that starts with wage push inflation because people just want to maintain their living costs. We mentioned this several months ago when inflation first started. We saw that people needed a $7 to $9 an hour increase in their hourly wages from a year ago, last May, to be equal to this year. Inflation is too many dollars chasing too few goods. And boy, we've got a problem right now. We have too many dollars chasing too few goods. And the Fed is trying in the most aggressive manner I have seen in my lifetime to try to stop that. But they're teetering on whether or not we're going to have to get into a recession. And they know if they do it too fast, it'll be a recession. But if they're too slow, inflation will never go away. So it's kind of that phrase, you're between a rock and a hard place. Key takeaways. We've got rising prices due to increase in production, shipping, raw materials, and wages. We have a surge in demand. People pay more for cars, for houses, for food items. I look at some of the food items in the grocery store that were 99 cents a pound. They're now $2.99 a pound. Some of the fruits and vegetables, $3, $4 a pound, used to be half that. Eggs, we see some of the numbers, but the point is some people reap the rewards of inflation because they're getting wealth transferred to them because they can charge more because people keep paying more. If you still want to buy eggs at $4 a carton, you'll buy them at $4 a carton. If you decide less eggs in my diet, I won't wait. Prices of eggs will come down. Oversupply. Again, I cannot encourage you enough that if you are a Wayniac because you're seriously thinking about what I say and maybe you want to do, because if you feel what I'm saying and something happens, that's good. Because I say what I feel, but you got to feel what I say. Then you're going to start looking at a lot of options you never looked at before. And inflation is nothing more than wealth transferring from one group of people to another group of people. You got to look at what are some things you would like to have that if the prices come down, you're definitely going to get them. It could be furniture. It could be a vehicle. It could be anything. But we are going to have a problem with inflation because some people will have to sell things and they'll have to take a loss. And so the key in any market, whether it's the inflation we're going to have, it looks like longer than we expected unless something happens, or it's a recession, which we know will happen. The question is, will the Fed push it too quick or will it show up in 2023 in much more detail? Either way, wealth is transferring from one group of people to another group of people. You have to learn to be the transferee in both of those markets instead of the transferor. That's all it is. The transferee instead of the transferor. You want to be receiving wealth in an inflationary period of time, i.e., in Wayne's world, every one of my income properties had an increase in rents, some a pretty sizable increase. The money was there, I might as well go after it. Somebody else is making more money to get some other services done, to buy some other products. Somebody is buying those fruits and vegetables at $4.99 a pound when they used to buy them at $1.99 a pound. Who gets the money? That's another whole issue in the process. These are some key takeaways. And we're seeing a rise in prices of goods and services that have never happened in over 40 years. It's the balloon theory. The balloon blew up too fast. Look how simple 3% looked. And look at all the years we've had these low 2%. We actually were down to 1.67% at one point for loans many years ago. I remember for an adjustable loan at 1.67 to start. Now we're only at 5.6, which is not bad. People blow that out of proportion. Once again, in Wayne's World, borrow as much as you can, pay it as fast as you can. Don't worry about the interest rate when you buy the money. How fast can you pay for the money? So you can borrow more money or maybe refinance. And there's great lenders out there that will do that for you and get you into an investment at a price before then later. The drawbacks to waiting are always devastating in an inflationary market. 5 facts. Federal Reserve tells us what it is. In fact, technically, we are in a home builders recession, but in the real world, we had 2 negative growth quarters, and that makes the official definition of a recession in the marketplace. The problem is we've got inflation. We've got too many things that can not cause the problems that we had in the last big recession. But it's caused by basically many, many factors. But the common line in Wayne's World is too many dollars chasing too few goods. You give me a pay raise, you pay me more money, I got to produce more. In my negotiation training, we have a segment called Pay for Results Only. Negotiating your fees based on the results. Bring you more money, we earn. Bring you less money, we take less. Pay for results only. If I do a great job, give me more. If I don't do such a great job, I don't deserve more. Third point. Remember, it wasn't that long ago that we celebrated 2021. The average inflation rate for the whole year was 1.4%. We are at 8.3%. We are close to 6 times the inflation rate that we had in all of the 12 months of 2021. Those who don't understand history are bound to repeat it. What was the economy like back then? What happened now? A lot of free money out there, a lot of people receiving grants, monies for this, money for that, but no production. I don't care if anybody gets thousands of dollars. They've got to produce something in the economy, or we have too many dollars chasing too few goods. And we'll see what happens. Number 4, the Fed tomorrow will be doing one of its 6-week meetings to modulate inflation. But we're at this point where they're modulating it at such a fast pace, at such a rapid pace, it really is blowing up the balloon. They still have a target rate of around 2.25%. That was solid since 2012. 10 years ago, we set that target rate around 2%. I think we're at 2.25 is the target they're still using. The problem is we never had what just happened in the last 8 months, 9 months, in the last 10 years. And that's the difference. That's where we're at. Something happened in the last 10 months that never happened in the last 10 years. And here we are. Everybody has to adapt. But once again, your personal inflation rate may not be impacted nearly as much as you hear in the headline inflation and maybe even in the core inflation. So, what price do we pay? See, if you understand the cost of inflation and you're not reacting, you're paying the price for inflation. But if you listen to Wayne's World, look at some other people who you feel are explaining this in a way that makes sense to you and it creates an investment strategy that you would use, then you enjoy the price of inflation. See, some people will pay the price because they're transferring wealth. Some of us will enjoy the price because our passive income will increase. But these are the factors that cause problems. People don't understand. They got a $3, $4, $5, or $6 an hour pay raise this year, and they're behind. How do you tell someone who's making $12 an hour, $15 an hour, and now making $20 an hour, they're worse off? You got to cut back. They created more debt. They bought more stuff. And that's our cycle. So are you going to be paying the price of this inflationary market, or will you be enjoying the price? I sure hope if you follow the processes, the procedures, and the perspectives that I present in Wayne's World, you'll be a Wayniac and you will enjoy the prices of inflation. And these are just some numbers. This was from February. You can look at back today. By tomorrow, by Thursday, by Friday, we'll see this same chart pop up on some website or some search engine to see how did gas prices. So for example, gas will have shown it came down. But I got to tell you, rental cars sure haven't. My gas bill sure did not go down. I realized in just booking some airfare for November what the difference was. Eggs are up bigger than 13% from February 22 to 21 year to year. So look at the year to year for September or August. That's probably the best data you'll have. And that's how inflation will affect you. So if you don't eat peanut butter, you don't care. If you don't buy furniture, you don't care. If you don't use gas, you're all electric in your home, you don't care. If you don't rent cars, you don't care. So the personal inflation rate is the secret to understanding how this impacts you specifically. The key components with your money is you buy stuff, that's consumption. You invest. Sometimes you pay in full for the investment. Sometimes you leverage the investment. Sometimes you speculate on the investment. I have several friends who speculated on buying new vehicles, new luxury vehicles, and they've made a tremendous profit because people were paying way overpriced for certain automobiles, way overpriced. And then you want to avoid taxes like poison. One of Wayne's World's 10 commandments of wealth building: avoid taxes like poisons. Tax avoidance strategies are legal. Tax evasion strategies are illegal. And then you want to have some money set aside, not for savings, but for savings. A safe fund, SAFE, a set aside fund for emergencies. That's hard to do, but then you have to have the knowledge on how best to do that. Some people are saving at 0.1%. Some are saving at 2.2%. Some people pay way too much in taxes. This is the time of the year in my marketplace where I have to start appealing all my property taxes. This is the time when I have to start looking at end of the year tax strategies with my Section 179 deductions for things I'll buy for my real estate home office or some equipment. Maybe it's a new phone. Maybe it's a new computer. Just bought a new computer. Just bought a new 4K laptop. I can write the whole thing off this year against my income, furniture. And then I have to find ways, can I consume at a cheaper or better price? In my lifestyle, what ways can I buy or consume and pay less for the same thing somebody else pays more for? So we'll look at that later. But for right now, that's just kind of an idea where we're going. With that in the background, let's look at this. Best ways to play the lottery and win. Kind of a fun way of looking at things. By not playing the lottery, putting the money away, you can make more money than probably playing the lottery. But it's your choice. I just threw that up there just so you can have something to look at and get some idea of what some people are spending at $20 a week on the lottery. That's $1,000 plus. That's a couple $1,000s in 2 years. And if we get this 2.2% on our money, like right now, or maybe more, because short-term interest rates will probably rise. In fact, right now, if you're a very, very, very conservative, I don't like risk stuff, Wayne, but I like what you're saying, but I won't do that, then at least take short-term CDs. The shorter the term, probably the better off you're going to be for a while. The long-term CD, you could be hurt if you lock into a 2 or 3 or 5 year CD these days. But basically, just be careful how you use your money. So, best investments. Obviously commodities, but risky. Real estate, powerful. And then we have hard assets. I said I would give you 5. Gold, silver, diamonds, real estate are 4. If you want some government protected things, because you're not the big risk taker, then we'll talk today for a short time about TIPS, Treasury inflated protection securities. TIPS. But the key elements that always win in the long haul in inflation: gold, silver, diamonds, platinum, real estate, all hard assets. The advantage of real estate over gold, silver, platinum, and diamonds is you can leverage the investment. A lender will give me a loan on some or all. It just was announced that Bank of America, among many banks, are offering 100% loan to value, no money down on homeowner loans. I can envision some people buying a home, maybe with a first-time home buyer credit, with very little or no money down, not just VA anymore. Bank of America says anybody if you qualify. Living in it for a year, building some assets, doing some things, then keeping it as a rental property and buying something else. I can see that happen. What a powerful opportunity to get into the home ownership market, then look at it as an investment. Take the first-time home buyer tax credits that are available from the federal, state, and local governments. And then after a year, maybe you'll be able, or 2 years, maybe you'll be able to keep it as a rental property. The last house I lived in, I moved out of 15 years ago. 6-bedroom home. It's been rented for the last 15 years. That's Wayne's World. Anybody can do that. If I can do it, anybody can do it. Be a Wayniac and get serious about buying at least 2 a year and holding on to them. Now, food storage is there because, as you well know, if you bought some stuff in quantity 3 months ago, 6 months ago, that are not perishable, you got to look at the dates. My best story is I bought 100 cans of Progresso soup. It's good till 2023, I think, September. I bought it a while back. But ever since I bought it at 99 cents a can, the cheapest I've seen it is $1.99, and most of the time it's at $2.69 or plus. So instead of paying $269 for the same 100 cans of soup, I paid $169. Excuse me, I paid $99. It's a big difference. So food storage, and some of you may have some things that you bought, whether it's toothpaste or perishables, non-perishables, and now it's twice as much money. Now, you can't buy perishable items doing this, but I've loved to watch some of the most, I would say, devout Mormons who believe in 1 full year of food storage. And look at some of the ways they store food. They have racks and shelves built in their homes that look like grocery stores. They're tilted so the old stuff comes in first to use, the new stuff goes in the back. It's a huge, I learned a lot from watching Mormons understand the power of 1 year supply of food and supplies. Learned a lot. I would suggest you look at that option of food storage. But more importantly, as we wind this down today, what's your personal inflation rate? That's the key. It's personal. If you have friends in a warm climate, their pool is open 12 months a year. They don't even change the water. If you got a pool in a cold climate in Illinois, what are they going to do? They come and open the pool. They cover the pool. They take half the water out. At the end of the year, they cover it up. They take the water out in the spring. Thousands of gallons of water, thousands of gallons of energy being used to heat that pool. Different kind of pool cost living in a warm climate with a pool versus a cold climate with a pool. But again, cities, if you don't drive, as you well know, some states have no income taxes. You're not impacted by things. So you've got to look at a personal way of what and how you live and how it's impacted by the cost of things in those minds. See, your personal consumer index versus consumer price index could be much less. And again, it's that core inflation rate that's more usable than the headline inflation rate. But most importantly, taking the core items and making them your personal inflation rate. Your personal consumer expenditures are much, much different. And maybe in some cases, they could be above the line. Maybe everything that's go up in value, you use. You use a lot of eggs, use a lot of gasoline. Now you're happy for it. Use a lot of other items that have went up in value. Well, you pay the price versus enjoying the price. So what are some best tips to leave you with to prepare for continued inflation at a rate that I just am shocked we may have to keep going to for a longer period of time than I anticipated, but I will keep watching it. Because there's a risk. The risk of this time bomb that's going to have to blow up at some point in time. So again, one item that is not a hard asset, it's an investment backed by the government, are TIPS, Treasury Inflation Protected Securities. The investment's tied to the inflation rate. So right now, you can get these securities in 5, 10, and 20 year. I wouldn't recommend the long end from my perspective. But if you want to do that, that's your choice. But that would protect you as inflation goes up. They pay you the inflation adjusted principal or the original, whichever is greater. Well, if inflation's going up, it's going to be greater. Now, these don't work, and that's why I'm saying a 10, 20-year plan, I hope I'm right. I can't predict the future. If I could, I would be someplace else. We won't have inflation for 20 years like this. That would be staggering. I mean, inflation for 20 years at 8% means every 9 years, everything is doubling. So by 18 years, everything would quadruple. Just think everything 4 times as expensive as it was. I do not see that happening. So I could live with TIPS for a short term. The shorter the term, the better. To adjust if I wanted a government investment because I was a bit less riskier. Your guts gauge. See, in Wayne's world, I believe everybody has a guts gauge. Some people are very, very risky. Some people are very, very conservative. Guts gauge, where's yours at? You take the risk. TIPS are a way to get a little bit of the benefit from the government. They're a great hedge, as many other investments are. The idea behind them is the rule of 72s, as I just said. If the interest rate is 8%, which it is, and the inflation rate is 8%, which it is, every 9 years, everything doubles. If you were able to get an 8% investment, if you saw your real estate going up at 6%, take you 12 years to have your real estate investment double. Plus, if you borrowed a lot of money on it, you've leveraged it, so it went up the same as if you paid for it in full. That's the beauty of real estate. There's other ways of looking at this, which we maybe will talk about in more detail in future events. One's the rule of 114s, where money triples in value, investments triple. The rule of 144, where investments quadruple in value. Rule of 72 is people learned a lot somewhere in school. I think in Wayne's world, the rule of 114s, the rule of 120 of 144s is much more realistic, because I would like to see a better perspective of how my wealth can grow. And once again, with real estate, much of that growth could be without your own money. That's the beauty of leveraging. That's the beauty of leveraging. So, some of you have stocks and bonds. That's your portfolio. Some of you have active types of income. You got to pay for it by spending your time. You're trading time for money. That's your job. Some of you spend a lot of time, a lot of activity, very little accomplishment in real estate. Real estate is a very simple game if you understand the power of not wasting time. In this business, if you kill time, you murder your success. But if you can get something done in a short period of time, then your net is probably as close to your gross. But the key in Wayne's World is continually every day finding ways to increase your passive income so your passive income is greater than your earned income or your active income. So at some point, you don't need any active income. It's if I want to work for a day just because I want something to do, fine, but I don't need that to live, survive, enjoy, prosper, and maybe give money away in philanthropy or leave something for my family or whatever the case might be in the process. Passive income is always better than active income, earned income. Again, you can make money quick. Somebody's doing something for a job today. I had a guy paint my garage last week. Took him a day. Didn't take him full day. Took him probably about 6 hours. I paid him $350. I paid for the paint. He made $350, 7 hours, $50 an hour. He didn't plan on doing that. He's the guy that does floors for me. He does wood floors. He said, I'll do it. Made some quick $350. But passive income, because he owns real estate, his properties he's been buying ever since we met are giving him income without working. So again, passive income is the key. If you have some investments and make some capital gains, that's wonderful too. Earned income, the sooner you get rid of it, the longer you'll enjoy more free time on your hand. You're trading your time for money. There's 86,400 seconds in every day. If you got to trade half of them, a third of them, a fourth of them, that's your choice. I know at some point you do, but in the real world, I believe passive income is the key, and real estate as an investment makes that happen. Many of you have seen this before, been put out by many different people. Robert Allen was the first person that showed it to me in his way many years ago. Probably the most recent person showing it is Bob Kiyosaki. But the concept is, how do I get money that works for me? Passive income versus I have a job and I'm trading time for money, everything in between. See, you're a real estate agent. You're self-employed. You're an independent contractor. That's better than being an employee because you got some flexibility. Still no leverage. But then if you start a team, get some other businesses going, own a system, get people to work for you. Like I said, if all of you want to come to work for me and 5 of you say I'll work for $50 an hour and I say, fine, bring me in 60 every day. Every day you each bring me $60 an hour in and I'm paying you 50. I'm making $10 an hour. 5 of you are making $50 an hour by working. I'm making $50 an hour because I hired you. That is passive income. You got to work for your 50. I don't have to work for my 50. The money is working for me. All of us are making $50. You're trading time. I'm not. That's as simple as I can make that without causing you to over educate yourself. Things are looking up. Taxes are higher. Your bills are higher. And inflation is higher. So you've got to make sure that your income growth, according to the cost of living, is above all those items going up. Otherwise, you're falling behind. So the more you know about the past, the better you are prepared for the future. Theodore Roosevelt. Or as Mark Twain said, and I paraphrase it, those who don't understand history are bound to repeat it. Those who don't understand history are bound to repeat it. So what did we do today? We gave you the 5 investments that work well during inflation. That actually gave you 6. Gold, silver, diamonds, real estate, food storage, and tips. Food storage is a touchy one, but I just know when I buy in bulk, not at Costco, I just look for sales and coupons. But Costco's fine too, or any other warehouse. I've got some advantages. Not everybody has the ability to store food. Nobody can some people don't have room for 100 cans of soup, or some other kind of item. So in Wayne's World, it's gold, silver, diamonds. Platinum's okay too, but it's pretty expensive per ounce. But real estate is the ideal investment. Why is it the ideal investment? Because of the letters in the word idea. It creates income every month. Somebody's paying you rent. You can depreciate it. Depreciation. if you own $3 million worth of building value by buying 2 properties a year, and those properties just break even before taxes, you will have $108,000 of depreciation to use as a loss or as a reduction of your income from selling real estate. Either way, if your 3 buildings break even before taxes, you'll have $108,000 in deductions. If you have 6 million, you'll have twice as much. Why? Because some people buy real estate just for the equity buildup. As I'm making loan payments from the rent I receive, the house is slowly paying itself off. The condo's paying itself off. Then we have the appreciation that it goes up. We have seen some numbers across the country staggering. Austin, Texas showed as high as 40%. Look at your town, your area's appreciation. And then the big one, the L in ideal, is leverage. I can borrow all or close to all with all kinds of sources, and there's money available. Money is not the problem. Just for some of you, the price of the money you have to pay, called the interest rate, is the problem. So I leave you with this. You win in inflation if you buy hard assets. You really win in inflation if you see real estate as your ideal investment. Waniacs are serious about buying at least 2 properties a year. If there was a Waniac fan club, as soon as you showed me after 3 years you bought 6 properties, you'd be a member. And if you kept doing 2 a year, wouldn't take long to be an honorary member, a lifetime member. Because Waniacs win. Waniacs win during inflation. Waniacs win during recession. In Wayne's world, you start with 1, 2, 3, 4, 5. If you want to get into a syndication later on, get into some partnerships later on, buy multi-unit buildings later on, I will never stop you from any real estate investment in any way, shape, or form. Even a real estate investment trust is better for some people, the REITs. So with that said, we had a full week, but Wednesday will be a rude awakening for us. So next Monday, we're going to have a lot to talk about to adapt to what the Fed said they did and what they plan on doing for the next 2 rate increases for the rest of the year. I'm so proud and pleased you choose to join me. You've got a great day ahead of you in Win Inc. and all our programs. Every day you can pick and choose from some of the best in the industry, and we just share because we care. Now, the question is, do you have knowledge? Yes. Is that knowledge power? No. This knowledge from today will not become power until you use it. Email me, text me, call me, and say, I bought 2 this year. I already bought 2 this year. I'm going to buy 3 this year. All I'm asking is take advantage of the industry we are bringing to other people for yourself. Have a wonderful week. Enjoy the official beginning of autumn or fall. And I will be back next week, hopefully with you and maybe a friend of yours. Take care. Enjoy. Glad you were here. Bye.